Fed Chair Jerome Powell has supported rate cut bets with comments overnight, although stronger US jobs data took the edge off that market reaction. The RBA's board minutes show a hike is still on the table and New Zealand's inflation pressures are easing. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior Commodity Strategist Daniel Hynes looks at how commodity prices are boosted when interest rates are being cut.
The Fed is the main player in this game, and until they start to cut rates, it's going to be a bit of a delay start, I suppose, to any potential rally in commodity markets.
But first, in 5 and 5 with ANZ, US Federal Reserve Chair Jerome Powell boosted expectations of a Fed funds rate cut sooner rather than later in comments overnight, talking about progress on inflation and a better balance in the jobs market. However, stronger than expected job openings data, while Powell was speaking, really dented the fall in US Treasury yields. But they're still down around 3 basis points at 5 a.m. Sydney-Melbourne time. The S&P 500 was up 0.4%. ANZ economist Bansi Madhavani says JOLTS, job openings and hiring, unexpectedly rose in May.
The number of job vacancies per every unemployed job seeker, which is a preferred measure of slack in the labour market, that measure was steady at 1.2. The strengthened labour market led to a U-turn in markets, with bonds giving up their intraday gains and yields rising back up. But importantly, markets pricing for September rate cut did firm up to 71% from 66% before.
The US dollar index was down 0.1%. The Aussie dollar up 0.1% at 5 a.m. Sydney-Melbourne time at 66.64 US cents. The Kiwi basically flat at 60.75 US cents. Number 2. The Reserve Bank of Australia's June meeting board minutes indicate inflation data at the end of this month will be critical for gauging the next interest rate move. ANZ Head of Australian Economics, Adam Boyton, says there's no smoking gun pointing to a hike at the RBA's August meeting, but enough to suggest the next move could still be a hike.
There was a considered discussion, as the Governor alluded to in her post-meeting press conference, around increasing interest rates at that meeting. Now, ultimately, the board decided that the stronger case was to leave rates on hold, but if you're having that conversation, that certainly does tell you, A, the bank still has a tightening bias, B, easing is not even being considered at this point, and we do get the all-important Q2 CPI on the 31st of July, which I think could be quite important for how the board then sees the risks around inflation at the next meeting.
Number 3. In New Zealand, the NZIER's June quarter business confidence survey showed weaker confidence and weaker price pressures. ANZ senior economist Miles Workman says the Reserve Bank should certainly be able to cut rates earlier than August 2025, which it signalled in May.
We saw things like capacity utilisation, labour as a limiting factor, ease of finding skilled and unskilled labour, all those indicators going in the right way to suggest that sticky domestic CPI inflation risks are very well mitigated and that the chance of a re-acceleration in inflation pressures is certainly quite unlikely. In terms of the costs and pricing measures, we definitely saw good progress there, with firms both experiencing lower costs and reporting that they will increase their prices by less.
Number 4. Europe's annual CPI inflation eased slightly to 2.4% in June, although core inflation rose and services inflation remained sticky at 4.1%. ECB President Christine Lagarde said overnight that more time was required to gather enough data to be certain on the inflation outlook. Here's Bansi again.
Chief Economist Lane said that even after June data, the question on services inflation wages outlook is still unanswered, and these data would only be available ahead of the ECB's September meeting. What in effect the ECB is doing is it's guiding towards slow, gradual and data-dependent rate cuts. We think what this translates to is that the ECB is likely to pause in July and then cut in September if data confirms disinflationary trends.
Number 5. South Korea's annual CPI inflation rate eased to 2.4% in June from 2.7% in May. That was slower than expected. Core inflation was steady at 2.2%. ANZ Asia economist Crystal Tan says the pullback was broad-based.
Coupled with softening inflation expectations, the conditions for easing pivot are gradually coming together. But at the same time, the Bank of Korea is also going to have to take uncertainties on the exchange rate front into consideration as well. So on balance, we don't anticipate a cut at the BOK's upcoming meeting next week, but we suspect the committee will turn incrementally more dovish. So the number of members signaling an openness to a rate cut on a 3-month horizon is probably going to rise.
crystal tan there. Now, in our bonus deep dive interview, my colleague Alex Tarrant talks with ANZ Senior Commodity Strategist Daniel Hynes about the connection between rate-cutting cycles and commodity prices. You guessed it, everything is hinging on when the Fed moves.
It's sort of counter-cyclical in a way. You would expect that cutting rates because of weaker sort of economic growth would actually hurt commodities, but it tends to go the other way. Easing cycles tend to result in quite strong gains in commodity markets, and that's for a couple of reasons. Firstly, the prospect in the future of those lower rates boosting demand, physical demand for consumers builds up, and certainly the cost of holding inventories is going to be lower under a lower rate environment. So we tend to see a restocking cycle emerge as those rates get cut. The second factor is investors really seeking that high-yielding asset, which under high interest rates was other markets such as bonds or treasuries. Now that those rates come back, a non-yielding asset like copper or other commodities tends to be seen in a more favourable light. So investor demand also picks up there. So the combination of those two things tends to mean, we see stronger performance across the commodity complex.
And just looking at the state of the current easing cycle, though, there are some divergences between central banks. So how is that affecting commodity markets as we enter the easing cycle?
Well, it brings a certain level of uncertainty. I mean, the ECB and some other smaller banks have already commenced those cuts, but really the Fed is the main player in this game. And until they start to cut rates, being the centre of the global finance market, then it's going to be a bit of a delay start, I suppose, to any potential rally in commodity markets. And look, that remains something which we're obviously following quite closely. I think the data so far tends to point towards rate cuts in the second half of the year, but inflation has been persistently high. And compounding that, I suppose, will be the potential for this rate cut cycle to be a lot shallower than we've seen in the past. Some of the previous cycles we've seen up to 500 basis points cut, which has really been, a really strong tailwind for commodity markets. This one around, obviously rates starting significantly lower than in previous cycles, and that, I suppose, spectre of inflation remaining relatively high. I don't think we're going to see that level of cuts this time around as well. So that's going to, I suppose, dampen the impact that we've seen in previous cycles.
And given those differences, how important a role do currency moves play over the next year or two?
Yeah, well, I mean, the US dollar has always been a pretty strong factor in commodity markets. And if we don't see, or if you see the Fed continue to delay that first cut, the US dollar is going to remain strong as investors look for those high-yielding currencies. So that could create further headwinds for commodity markets in the shorter term.
Daniel Hynes there talking with Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, July the 3rd. Catch you tomorrow with the latest on Australian retail sales. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.